The Fed has officially delivered what I and many others would consider to be the first Fed pivot, the first true Fed pivot. If you'll remember, before we thought the Fed was going to pause. They did pause. We were consensus on that. We said for once we're actually consensus. Now the Fed has, I would say, shifted dovish. They haven't done this. They have continued to surprise consensus in the hawkish direction. So now they have actually surprised dovish, and they definitely surprised me. I was not expecting this kind of dovish move. However, I don't think this fundamentally changes the game that much. Let's not forget that what they are doing is focusing essentially on the short end of the curve. The long end of the curve does not move as much. The curve is still inverted. However, that doesn't mean that there aren't things to consider when thinking about the markets and the economy in a broad sense. There's plenty of things to talk about and think about and consider. So we're going to get into that. Ultimately, though, we think the Fed action today is benign and leads the Fed to be a benign force on the whole. So that's a return to normal step that I'm going to include and have in my paradigm to look at markets, look at stocks, look at businesses, and think about the economy going forward. I'm not necessarily going to think about or worry so much about the Fed in particular. It seems that they are calling peak, and there's not a whole lot I can see that will greatly dislodge that, even if I do expect oil prices to remain somewhat elevated relative to historic levels, firm up a little bit from this recent sell-off, these kinds of things, which we'll get into later in the video. Fed, overall benign, removes a heavy market overhang for better or worse. At least should be for better or worse. I think it might only be for better for the 69th time this year, but whatever. I'm not going to get into that. So when we look at things ex-Fed, this is where I think I differentiate from the consensus. It seems that my interpretation of consensus numbers, of market price action, of my interpretation of various commentary, is that some sort of reacceleration is going to occur from here. That, the worst is behind us and that the best is ahead of us. While, yes, I think it is a tautology, I hope for the sake of society, assuming birth rates don't, hopefully we can fix that situation, that, yes, the brighter future is ahead of us. That is my working expectation. However, the timing for that is very unclear. Not that I'm trying to imply that market timing is the game we're trying to play, but I think when you look at things ex-Fed, the picture is not amazing in my view. It's not this reacceleration. It's not that the worst is behind us. It's that the lag effects are here to come. But before we get to that, let's talk about where the market sits right now. The market currently sits right now at virtually the lowest earnings yield on record, ex the dot-com contraction, recession, whatever it was. Oh, it's very little. The great financial crisis, and the COVID crash when earnings came down. We are virtually at the lowest return in terms of actual productive cash flows for stocks in the S&P 500 ever. So if you're buying a stock, the earnings yield of the asset you're buying is virtually at lows. Now, if you're expecting that kind of explosive growth, that would make sense. However, that's not what I'm expecting. That's not what I heard this morning from Janet Yellen. That's not what I heard this afternoon from Jerome Powell. That's not what I expect on a historical basis after the Fed begins to hike interest rates and those effects begin to occur. Let's zoom out on this tightening cycle for a bit. Inflation was very high. Interest rates in nominal terms were virtually zero or close to that, 10-year, whatever it was, 1%, 1.5%. The Fed began hiking. interest rates began to go up. However, inflation was all the way over here. So you had a massive negative real interest rate. And it would make total sense to borrow at that level and invest in productive assets. That was a no-brainer for a period of time. And that existed throughout periods of last year. And as we went through in this year, finally, maybe now kind of, okay, now maybe we have something like a 1 and change, maybe percent interest rate on the risk-free rate of return, maybe a little higher now that you have to borrow money. So now we're getting to some sort of positive real rate. However, there are lag effects. This is a broadly accepted concept amongst both economists and market participants. So you can't necessarily draw the lag effects from the first rate hike from sometime last year. So I do think it is premature to say that the worst has occurred and these kinds of things. I think we have to move the line. I know how scary that sounds, whatever it is, and not good that sounds. We have to move the line to some esoteric point. I don't have the exact point. When real interest rates began to be positive, which I assume was at some point this year, maybe midpoint this year. So we're possibly a few months into that. The last Fed hike was in July, roughly the same period of time. The average recession does not occur for 9 to 18 months or begin 9 to 18 months after the last Fed rate hike. So I do think it is premature to say all clear, guns a-blazing, let the bulls out of the cage and run. I do think it's premature for that. Now, that would be one thing if the earnings yield were very high. I would be willing to take a risk in that situation. I would. Maybe I should have done that earlier. I've learned plenty of lessons this year. However, to take that kind of risk when the earnings yield is less than the risk-free rate of return, much less than the federal funds rate, meaning I can park my cash, get that yield, and have liquidity. No, maturity risk, no duration risk, controllable currency risk. It just isn't a good bet. It's just not a good deal for me. And I'm sorry that, I can't go all bullish right now. I get it. That's the market consensus. I get it. I've been wrong being bearish this whole time. I see the market. It's not fun. It's not fun for me to not be outperforming in this period for an extended period of time. It genuinely sucks. But I'm not willing to make that kind of decision. Warren Buffett, I get it. He has a lot of Apple. That is a very strong company. It's a tech company. It's a relatively high multiple company. However, believe it or not, this year he has been a net seller of stocks. Net seller of stocks, Warren Buffett. So I don't think I'm the only one that is a little hesitant right now. So eventually cuts will come. But I don't view it as some sort of binary, you buy the Fed funds rate cut. First of all, what matters is the 10-year, the longer term rate of return that is being priced out in the market. And it did come down a little bit today. Came down, 10 basis points or whatever. But it's nothing crazy. And even once interest rates do begin to get cut, it's not as though zero interest rates are returning. They're going to, over the course of 2 or 3 years, begin to get cut to the neutral rate, which on the Fed funds is somewhere around 2.5%. So that is supposed to be the lowest point on the curve. So you have the 10-year at 4%, the Fed funds rate, which has, none of those risks, none of those interest rate risks, no duration risk, no currency risk or controllable currency risk, these kinds of things, 2.5%. The 10-year is, in my opinion, based on looking at these kinds of things, is not going to move much from that 4% level. So to expect that non-economic growth forces are going to, affect interest rates in a way that will be greatly beneficial to stocks, I don't see that being the case. That is my analysis of the situation. The 10-year, I think, is relatively low here. I think it's relatively low. The yield is relatively low. And, the curve is inverted for a reason. The curve is inverted because the market already anticipates that interest rates will be cut in the future. So that 10-year being lower is, accounting for that. Nope, the 30-year is higher. The 2-year is also higher. So that is how I'm looking at the interest rates and the interest rate cuts. I think we are celebrating a lot. Now, if they went to zero, that would be a different thing. But I don't view them as highly, necessarily stimulative, going into stimulative territory. I simply view them as being less restrictive, which I don't think is necessarily some phenomenal thing when we're already expecting not a restrictive situation in which an economy and earnings act in a more restricted way, but one where reacceleration begins to occur, essentially starting next quarter, is from what I understand. So, economy expected. So we already talked about Jerome Powell and Janet Yellen on the economy. They cite other things, such as savings continuing to be depleted, and we can't ignore the signs on various company earnings calls. Of course, there are some companies that have secular tailwinds that are benefiting in some way right now from fundamental forces to that business. And I celebrate those businesses. I wish I owned more of them. I do own various companies which are having phenomenal things happen to them right now, but I'm talking on a more broad sense, not individual, although I would like to start talking about individual more often. There are plenty of signs amongst various companies continuing to engage in layoffs that are seeing slowdowns in their businesses or signs of concern. Everything from Hasbro and Etsy to Costco, which, yes, the stock is up and is on all-time highs, but is also seeing the size of its average ticket shrink. They said as early as May, consumers were trading out of various meats into cheaper meats, consistent with what occurs in previous recessions. So we're not in a recession yet, it appears, obviously. But there are definitely signs consistent with a recession that are occurring, and I'm very much aware of that. When we're at virtual record lows in earnings yield, I'm not so compelled to buy that virtual record low in earnings yield when there are signs of a potential economic slowdown, and we have people talking about essentially engineering further economic slowdown, not trying to stimulate growth. The whole idea of buying interest rate cuts is that they imply stimulating growth, but that is not what's occurring here. Not a pursuit of stimulus. So, that is my view on the broader market and the broader economy. Now let's take a look at oil. So if you go to my Twitter and you read my tweets from October 8th, the day after the Hamas attack, that was a Sunday, October 8th. October 8th. I said on that Sunday before markets opened that I believed that there wasn't anything to do with the oil market here. However, prices of oil were up some 4% the following day, held those levels for a couple weeks or so, were in the high 80s, low 90s, something like that. That was fine with me. I was happy to enjoy high oil prices. But as signs of the war possibly cooling hit the market narrative, justifiably so, prices kind of pulled back down. And since then, we've just totally cratered in this oil market. And we are now at record levels record low levels of net length, meaning net exposure to oil on the long end. The plus minus of that being the lowest it's been in as far back as the data I've seen goes. That is quite peculiar because I'm not seeing any necessarily catastrophic sign for the oil markets. I'm actually seeing positive signs for the oil markets. It's not as though we're seeing massive crude builds. We had a few builds. We've seen some gasoline builds. Some of that gasoline build has been because of heating oil. I'm not, a number one geologist here, okay? But when you refine a barrel of gasoline, you get various products. There were massive spreads in some products. You look at PBF, they earned $6 a quarter last quarter. That was because of things like heating oil, various weird products that use oil that just had massive spreads relative to the oil price per barrel. So there has been some excess gasoline for those reasons. Gasoline consumption is very high. Jet fuel consumption is very high. The consumption picture is very high. I understand some U.S. production has picked up, okay, but we're at record oil consumption. China recently hit record oil consumption, I believe. The world is continuing to chug along, even in great financial crises. Yes, the price of oil is very volatile, but consumption of oil doesn't seem to change that much. Even though it does change, it doesn't change that much, and we're not in some sort of GFC yet. So I'm not seeing. I'm looking at the numbers. I'm trying to find this. I desperately want an explanation for this pullback, and I haven't been able to discover one besides record low net length in oil prices, which is very bizarre and honestly concerning because if there's a short squeeze, which we'll get into momentarily, that would be concerned. So what could possibly cause a short squeeze? Well, if you look at the commentary that came out of the OPEC cuts, and yes, okay, they weren't that big cuts. I didn't know that they were going to cut. I didn't think they were going to cut. I was surprised that they even cut. So I'm happy that they're cutting because it's not my companies that are cutting. My companies are increasing production. Devon, 10% year-on-year production per share after buybacks, after growths in production. Petrobras, Brazil is doing tremendous increase in production. Anyways, OPEC, commentary. They say that their cuts, they project, will be enough to offset Q1 inventory builds. Now, Q1 normally sees inventory builds. What they're saying here is no Q1 inventory builds. So if you have no Q1 inventory builds, when inventories are already at, I don't know if they're record lows because I don't know what the inventory levels were like in 1910, but they're definitely low for most of the data I see, the lowest for most of the data I see on global inventories. Q2, Q3, that is the season. That is the driving season. That is the consumption season. So you have no Q1 historical builds. Then you go into those Q2, Q3, you see further drawdowns. I don't know if that's going to be a good situation, but it's on my radar. I am not seeing anything catastrophic for oil. I'm long these stocks. I'm buying them. They're buying them. They're buying the stocks, so I'm owning more of them, not spending any more money. And they're producing cash. They're producing cash. They're relatively cheap. Oil price isn't somewhere it hasn't been all year. It's been here multiple times throughout the year. It's been volatile throughout the year. It's been volatile always. So, in a market that is at near record low earnings yields, energy stocks are tremendous earnings yields. They account for 4% of the S&P 500's market weight, but they account for 12% of the S&P 500's earnings. That's where I'm hiding out. That's where I feel comfortable. You're welcome to make your own decision. That's what I'm doing. That's how I'm thinking. That's today's video. And until next time, peace out.